Alright everyone, welcome to my YouTube channel at Illumination of NG. Don't forget to subscribe to the YouTube channel, and also you can have access to any of the videos I'm going to be dropping. So today we're going to be looking at IAS 2, and we're going to be looking at accounting for written down value. Okay, so recognizing the written down value in the accounts, and also the reversal of the written down value. So we have according to the IAS, okay, so I have IAS 2, which is on inventory. Okay, and we're going to be looking at the recognition slash accounting for written down value, also known as WDV. Now, before we can have a written down value of an asset, just like some of you who have experiences in computing for non-current assets, such as land and building. You know that you used to have depreciation after the cost of the item. You have less depreciation, then you have the written down value of the asset. So basically, written down value only expresses the assets after you have deducted any form of depreciation. That is in the case of a non-current asset. Okay, so for us to have a written down value in inventory, okay, so what we are simply saying is that we're going to have a situation whereby the cost is higher than the net written down value, because based on provision of IAS 2, we are to recognize the inventory based on the lower of cost and net realizable value. So let us just make an illustration here. Okay, so that's what we're going to be recognizing. Now, for us to be able to get the NRV based on our previous video, you can check the link. So our NRV equals to selling price sales less cost to sell. Okay, so kindly have this at the back of your mind. This is not difficult. Okay, so what we are saying is that where the cost is higher than this NRV, then we're going to have a written down value. For example, you bought an item for 10,000 naira, and the NRV, that is the fair value in the market, reveals that the asset can only get you at the end of the 7,000 naira. So therefore, there is a written down of value of how much? That is 3,000. 3,000, okay? So that's WDV. Because the asset has further declined in value, it has reduced by 3,000 naira. The initial cost of the asset is 10,000, of the stock or inventory is 10,000, and the net realizable value is now 7,000. So in this case, we're going to have a written down value of 3,000 naira. Now, based on when you go to your icon pack, there is a particular illustration made on icon pack about a component A1. If I still remember that question. Okay. We're told that component A1 has an initial cost initial cost of 8,000 and the net realizable value is 7,300. Okay, so you can see that, and based on IAS, for us to be able to recognize the cost of inventory, we are to what? We are to pick the lower of cost and NRV. So in this case, the NRV is lower minus and the cost is higher. By how much? That is 700 naira. So how do we recognize this in the books of accounts? So what we do is to what? Is to journalize, okay? In the journal or ledger entry, journal. So we take this to what? To cost of sales, also known as cost of goods sold. Then we also have the inventory account based on the double entry principle. So you debit, credit, okay? So in this case, the cost of sales will be debited with what? The value of the written down value. The written down value, you debit it, and you credit the inventory. So this is in form of an expenses, okay? So we're going to what? So assuming the 700 naira, we debit, put the naira sign, Then we're going to recognize the what? The credit arm, okay? We credit, that is, for every debit entry based on our double entry principle, for every debit entry, there must be a corresponding credit entry, okay? So in this case now, we have generalized. That is, the value of what? The value to be recognized, okay, is, as a written down value, is 700 to the cost of sales and inventory to what? To 700. This means that what the inventory we're going to reduce by 700, okay? So this is how to recognize the written down value of an inventory. But there are cases whereby you may have reversal. And reversal may only occur. So reversal of written down value. So reversal may only occur when the cost, the initial cost of the inventory is now lower compared to what? To the NRV, which is now higher. So in this case, we're going to reverse the WDV. So what we're saying here is that, assuming that the initial cost is now 7,300 and the NRV is now 8,000. So in this case, the initial cost is now lower and the NRV is now higher. So what do we do to generalize? To generalize this, we have cost of sales, we have inventory. So we have credit the 700 back to the cost of sales and debit the inventory with the cost of sales. So this is how to reverse back the written down value of inventory. So this is quite simple, just for you to have an idea of how to write down the value of inventory. So let me just call your attention to something. Remember that for us to prepare the statement of financial position, the income statement, not the statement of financial position, the income statement, okay? The income statement, statement, okay? So don't mind my writing. We have revenue, okay? Less cost of sales, also known as cost of goods sold. So we have revenue. So we can have carry, but let us just put it this way. So we have cost of sales, okay? So we are going to have PBT, okay? In this case, we have PBT. Then when we have tax, we recognize tax, okay? At the end of the day, we're going to be left with what? The PAT. Now, this cost of sales must have gone through some workings, okay, some notes. So how do we arrive at the cost of sales, okay? So we know that to arrive at the cost of sales from our knowledge of accounting, okay, our cost of sales, our cost of sales, our cost of sales, cost of sales is purchases, add, sorry, let me clean that, that's an error. We have opening stock, so we have opening stock. There's nothing wrong with this. Let me clean that off. So we have opening stock. With this, okay. So we have, this is not responding. So what we are saying is that for us to be able to calculate our cost of sales, so why this is still loading, so we have our opening stock. So the opening stock, add purchases, okay. Then when we add purchases, we what? If we have carried inwards, so we had back carried inwards, then we less what? We less the closing stock, okay. We don't less the closing stock. The closing stock or the closing stock of inventory or the closing inventory, pardon me, the closing inventory is what we must have derived from the lower of cost of inventory or the net realizable value. So what am I saying? Let me try and display that while this is still trying to load, okay. So let me try and display that here. We have purchases, okay. So we have purchases. We have opening stock, sorry. We have opening stock, okay. We have add purchases, okay. In case we have carriage inwards, we add that, okay. We have this, we have a cost of goods available, okay. We less, okay. So when we have the opening stock, purchases, cost of goods sold, okay, we less closing stock. So we're going to less closing stock, okay. So we'll be left with what? With cost of sales. Please pardon my writing, I'm trying to manage this table. So the cost of sales, just as what we have here, is what we now bring down here. And note that the cost of sales is the lower of cost and NRV. The lower of cost and NRV. So what we get, if we're able to get this, the cost of sales, we transfer that back to the income statement and we take it off from the revenue or turnover. So what we are saying again is that there are times whereby there will be a loss in the net realizable value due to the difference between both values, that is the cost and the net realizable value. So when this happens, or when the cost is higher than the net realizable value, we're going to recognize the WDV, the written down value, into what? Into the account. And the case where the NRV is higher than the cost of sales, the inventory cost, sorry, we're going to what? Do a reversal. So thank you very much for your time, and see you in the next video where we're going to be doing more calculations. Thank you and have a great day. Bye-bye.